This is CNN.
Hi, this is Alessandra from the New York Stock Exchange, and we have with me Eddy McClough. Again, you do so much research, and it's always so interesting. We talked recently a lot about negative interest rates and negative interest rate policies. But first of all, what is it? What is a negative interest rate?
Hello, Alice. Well, negative interest rates are when the bank, instead of you, makes a percentage interest rate when you leave money in the bank. The bank charges you, say, 1% for leaving money in the bank. So what happens over time, you're going to get tired of that. You start with $100. You're going to have 99 the next year, 98 the next, 97, and so on. And at some point, you're going to take the money out of the bank, put it on your mattress or in a safe, or you're going to take the money and prepay your bills, utility bills, stuff like that. And when that happens, it sucks money right out of the economy. And not only that, it changes the behavior of the consumer and the investor. So then, they both go into a position of not spending.
True, and we all know that consumer spending drives the US economy, about 75% of the economy. So I can't imagine that situation will be good for banks either, with people pulling their money out. Will the world's banking system crash under this scenario?
The currency that flows in the world, if you take the cash, essential paper money, out of the banking system, that's what's going to happen. And the other thing is that the banking model doesn't work long term. In a negative interest rate environment, basically, a 1,000-euro banking model cannot exist. The banking system will eventually fail unless the interest rates go back to positive. But, well, then, I'm not going to sound the alarm. But what I'm saying is, in this scenario, there is a high probability there will be a crash.
And that for sure will have some very negative implications for the stock market.
Well, it does. It has tremendous implications for the stock market. Because what happens, those long-term investors like pension funds, endowments, wealthy people who have long-term investment horizons, they get scared when you have all this going on. So they pull their money out of the market. And they're buying sovereign bonds, which is what we're talking about. And why are they buying these sovereign bonds? Because a sovereign bond is protected by the full faith and credit of the government, which has the ability to tax their citizens. So they put their money in these sovereign bonds all over the world. And that said, there's only 3 countries which you can buy sovereign bonds in. But there's only one of them right now, the United States, where you can get a positive yield on the sovereign bond. So, in Germany and Japan, the yields have gone negative. That's why I've been sounding the alarm on Germany and Japan going negative for a while. Furthermore, because there's only one country left with a positive interest rate, everybody is going to be buying US sovereign bonds because they know that the US has the ability to tax businesses and their citizens guaranteeing these bonds. As an example, to fix the economy after the Great Depression, taxes in the United States were made as high as 90%.
Assuming the central banks don't abolish negative rates, the Bank of Japan is negative, the European Central Bank is negative, maybe even going more so, as they're open to that. What kind of predictions are you making for the stock market reaction between now and the end of 2017?
Based upon my research, mathematical research, I took a look at data from the crash of 2008. At the market bottom on March 9, 2009, I found that what actually reversed the negative interest rates was that the yield on other assets, like real estate and dividend-paying stocks, went up. Conversely, a main way that a yield can go up is if their stocks go down. And that's what exactly happened in 2008. You look at the charts before, and there is a situation where you can see the stock price collapse on American Electric Power. It's a dividend-paying stock, a utility, and you can't invest into a better opportunity than a utility company. Why? Because no matter what happens to the economy, you're still going to be paid your dividends because if the consumer doesn't pay their light bills, they get shut off. Therefore, they're one of the best investments you want to make. But even with the crash of 2008, American Electric Power stock fell from a dividend yield of around 3% at the top to a dividend yield of 9% at the bottom. So those people who owned the sovereign bonds sold them and bought the stock. So, the S&P 500, its yield was 4.7% on March 9th, 2009, when the market hit bottom. So assuming it's going to be deja vu here, and that the yields are going to have to get down to 4.7%, the S&P 500, based on its current deal, will have to decline by more than 50% if these negative interest rates don't go away, and the market would have to crash to get them to go away.
So you think this will happen fairly quickly?
When I sounded the alarm about Lehman and those guys, it took about a year. Well, Bear Stearns fell first. And yes, it'll probably happen in the next 12 months if interest rates don't change. The other thing I would like to add is if you look at historical dividend rate for the S&P 500, when it peaked in 1930, after the crash of 1929, it fell 50% and didn't get back where it peaked again until 1955. And by the way, I'm using the dividend yield based on the dividends paid on December 31st, 2015. There's a lot of companies in the S&P 500 that are lowering their dividends. And their dividends, many will be lower. While I believe the S&P 500 could easily decline by more than 50%, well again, I'm not trying to sound the alarm, but the probability is there is going to be a crash if interest rates remain negative. But who knows? I could be off on this, because maybe the Japanese and the European central banks wake up one day and say, let's get rid of these negative interest rates, which in that event, there won't be a crash. But I'll highlight those situations when I see them.
Okay, thank you, Eddy McClough of Eagle Gates Group. To find out more, you can go to the website eaglegates.com. Thank you for joining us today on CNN.
Thanks for having me, Alice.
CNN.